Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending September 19, 2025. So busy week, we had cuts from the Federal Reserve in the US, another cut from the Bank of Canada here at home, and the topic of the review is, well, one down and how many to go. This is for the Fed, of course, because for the Bank of Canada, we're pretty much done here. We could have another cut by the end of the year. Now it's mostly, I would call them safety cuts. We're squarely into the neutral territory. We don't think that these cuts will be changing anything other than give, a stronger basis for a stronger foundation rather for 2026 and 2027, because we've repeated that ad nauseum in 2021, 2022, and also 2023, that anytime a central bank moves, it hikes or it cuts, it takes 6 to 8 quarters before we have the full impact of those decisions. So as we're getting into 2026, we should start feeling the full impacts of the cuts that we've seen since the summer of 2024 here. But the bank decided to cut, and we'll share our opinions on what's next here. So, but before we get going, I'll look at this week's markets at the close on a Thursday. So positive for bonds, positive for equities as well. The price of oil was higher. The USD was down. Price of gold was volatile, ended up a little bit positive here, but nothing really changes in this picture here. It's still global ex-US equities that are performing better than US equities. Now, looking at the Fed, a first cut in 2025, this is what we just had. It was a 25 basis points cut, and there was a dissent. The new Fed governor, Stephen Miron, nominated by the White House, saying that he's independent in his analysis from the White House, but he's still holding his job at the White House. So you can, come to your own conclusions here. But he was a dissenter. He wanted 50 basis points of cuts. And when you look at the dots on the right, so the famous dot plot from the FOMC, FOMC has 19 members, 12 are voting at any given time, but you have the 19 dots here. You can see the dispersion of opinions for 2025, 2026, and 2027 and long run. So what you can get from this is that even at the Fed, there are multiple opinions on what they should be doing. It's not a trivial time to be a central banker in the US, given the political influence, of course, but also looking at the U.S. economy. We are in this air pocket right now where we don't yet have the full impacts of the change in trade policy. This is to come as well. Different point of views, very complicated time. But if we look at the 2026 column chart on the right, the column on the left, you see that there's a lonely dot at the bottom, which is, of course, Mr. Miron. He was wishing for 150 basis points of cuts this year, so 3 times 50 likely. He didn't get his wish so far. But you have a lonely dot on top as well, someone who was wishing for no cuts at all this year. So that means someone who thinks that we should hike rates from here. There were 6 members who thought that, this should be one and done for the year. But the median of the dot, the one that is highlighted by the black line, is pointing towards 3 cuts in total this year, 1 down, 2 to go, and there's 2 more meetings. So, likely we will have cuts at every single meeting in 2025. That means October and December. Now for 2026, the FOMC committee is pointing towards 1 cut. Market is seeing 2 or 3. So there's already some disagreement here, but the dispersion again is very wide. And, if you go in the future, it becomes even wider. So it shows how complicated the situation this is. And maybe just, to bring this on the macro, from a macro lens, if you're the Fed, and by the way, the Fed, they decided to cut rates, but they also at the same time revised higher their expectations for inflation. And they don't speak about inflation pretty much at all anymore. They're focused, dead focused on the labor market. So what that means is that the surprises will come from the blind spot, and the blind spot will be inflation surprises. So inflation surprises just became a very important indicator to follow for the pricing of the Fed, because we don't know exactly how the Fed is feeling about inflation. So when you look at the US macro situation, you see that there are, there's multiple Americas, but here we'll focus on one very important distinction here. the rich versus the less rich, let's say. So the chart on the left shows that the top 10% of earners is responsible for 50% of the consumption spending in the US. So this group, of course, is likely to be insensitive to the labor market. It's more about the value of their assets. And if the Fed starts cutting and cutting aggressively to support the labor market, then of course, their wealth, the wealth of the richest will rise quickly, and they could start spending some more and creating, immediate inflationary pressure within the U.S. economy. On the right, what you have is the view of the labor market. So there's two lines on the chart on the right. I'll take the time here. There's the unemployment rate, which is inverted here. That's the gray line. So when the gray line goes down, that means that the unemployment rate goes up, and it's inverted because I want to compare it to the blue line, which is what we call the labor differential. And the labor differential, this is just a survey data that they ask Americans, are you thinking that jobs right now are plentiful or hard to get? So the kind of a sentiment on the labor market. And as you can see, the blue line has been going quite lower. So that means that the labor market is getting harder and harder for the average American. So the Fed is talking mostly about the labor market. They want to support the labor market. But the question is, can they cut rates enough to support the labor market on the right without, pushing asset valuations too high and creating some inflation because of the guys on the left. So this is a very tough juncture for the Fed. It's not trivial to calibrate the path moving forward. And also you have other considerations like the inventories, which were built up pre-tariffs, but now that they're dwindling down at some point, they're going to have to be renewed at a higher cost. So inflationary pressure should come. We are already seeing, the emerging buds, let's say, of this story of inflation. It's not yet there, but of course, at some point it will have to show up in the data. So a very important distinction here. A lot of uncertainty within the Fed. The market seems to be quite confident that we're going to get a bunch of cuts. So again, 2026 is going to be interesting. And again, I want to mention this, that if the White House has its way and gains as much influence as we think that they would like to have on the Federal Reserve, especially in February when there's the renomination of the regional Fed presidents, then maybe all of this analysis goes out the window because Trump wants lower rates and he's going to get that. So very complicated situation. We'll keep you posted as we move forward. Now, quickly for the Bank of Canada, was it necessary? We don't think so, but it's there. We could have another cut by the end of the year. This is just to have a more solid foundation for 2026 and 2027 for the Canadian economy. We're already starting to see good things. If you look at the anecdotal evidence within the latest earnings season, same-store sales are rising. You're seeing businesses that are getting in better shape. When you look at the surveys, you see surveys getting higher. There's always some risk, but we do think that the fight on inflation, the chart on the right, this is pretty much done as well. Yes, we've had a few tough labor market reports, but now it's on to fiscal to do its job. So this whole story here, but maybe we'll end the year at 225, maybe we'll stay at 250, but hey, we have another rate cut here, so that's not gonna hurt, that's gonna help. And if I end here with what's priced into the market now, well, as you can see for the Fed, pretty much every decision in the near term, it's cut. After that, market is thinking that next July we should be somewhere around 3.25%. So I think that makes sense based on what we're hearing and what we're seeing from the Fed. But again, there's some uncertainty that's going to be cleared as we move forward, and we know more about how Trump wants to shape the Fed. And for the Bank of Canada, market is thinking, more likely than not that we have another cut by the end of the year, and after that, pretty much the status quo. This is what's priced in. So very important juncture, very interesting times, and we'll keep you posted on how our thoughts evolve. Now, looking at the data next week, we'll have the Bloomberg Nanos confidence survey in Canada, and we'll have Canadian GDP for July. In the US, we'll have a reading of inflation, the core PCE inflation, which is favored by the Fed, should be relatively stable, but the year over year remaining higher, and also we'll have some reading of the manufacturing and services sector to the PMIs from S&P Global. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content, please share, and of course, come back again next week.